Now that we're starting to see some light at the end of this pandemic tunnel, are you curious how the housing market's going to be affected in 2021? Hi, I'm Nick with the Iannitti Realty Group. Wanted to provide a real quick housing update for San Diego, but of course, provide you a little bit of context with what's going on in the rest of the nation. Coming off of 2020, we saw one of the best housing markets we've seen since the Great Recession. When we look at the actual forecast for this year, we're probably going to see more of the same. In fact, we're trending to see more sales than we actually saw in 2020. Home prices are going to continue to rise. We're probably looking at appreciation somewhere around the 5 to 6% rate nationwide. Of course, mortgage rates are still historically low, but just realize things will be ticking up through this year and into next year, which is typical when we see economies getting stronger. That's always coupled with rising interest rates. We're going to see the economy getting stronger as people start to return to work. And of course, the more people that return to work, we're going to continue to see demand for housing continue to be robust. So that's definitely good news. Looking at the mortgage rate projections, this is typically what we're going to be looking at. But I want to talk a little bit about where we're going to see listings coming from in 2021. There are right now people that feel comfortable bringing their home to market in the first half of the year. However, there's still going to be people that want to wait until vaccines are more widely available. Keep in mind that we also saw an increase in permits and new home starts at the end of last year, beginning of this year. So hopefully that product will be completed and back on the market this year, which is definitely good news for home buyers because again, we are still struggling with inventory. This is a look at our inventory nationwide. And for the first time ever, we're below 2 months worth of inventory. So we definitely need to see more homes on the market. This is the lowest standing inventory we've ever seen since the National Association of Realtors started tracking single family home supply back in 1982. Also consider that the pandemic has really changed how people are living in their homes and what they define as a home. You know, it now has to be not only where they live, but where they work, where they educate their kids, recreation, all these other things. We know though, as people start to come back to work and more people start to come back into the office, we're probably going to see some type of hybrid over this year and next year where people are maybe coming back to work only 1 or 2 days out of the week. They probably won't be back to a full work week. And that can also still have impacts on people's ability to commute. They may be willing to live a little bit further from work if they only have to commute 1 or 2 days a week. So just keep in mind though, that the rate that we saw things expanding from mortgage applications and home sales in 2020, we're probably going to continue to see that strong growth. We don't see anything that's really going to slow that down through 2021. Also keep in mind that there were 3 main reasons why people really didn't list their homes last year. A third of them were worried about financial uncertainty. A third of them were worried about just, life uncertainty, period. And 25% of them had some COVID-19 health concerns. Hopefully, as we get through with these vaccines and everything, a lot of this stuff will start to dissipate and we'll start to see more inventory coming. I've also had a lot of people continue to keep asking me about, forbearances and foreclosures and all this other stuff. Realize that at the beginning of this week, I think there were about actively 2.7 million people in forbearance. But when we look at the last numbers from June 1st to just January 24th of this year, just 3 weeks ago, 52% of these people have already paid off their forbearance. They're fine. 33% of them have some type of repayment plan in place. Only about 15% of them are still in trouble, right? And that's not good. We can definitely see those people fall into foreclosure. However, at these levels, it's not a crisis. And remember, I've told you in previous videos, we're still only at about half of what we are on a historical average for foreclosure. So even if foreclosures doubled overnight, that would still bring us back to our regular average levels. So again, not going to be a crisis. We're probably not going to see any of those foreclosure sales actually moving the needle on home prices. And in fact, it's the other way around, with such huge price gains and the level of equity that people currently have in their homes, we're probably going to see less distressed sales. We'll probably just see those people wind up being forced to go on the market, getting market value for their home. And basically, ultimately, it could lead to more sales, helping some of our inventory. But again, with our inventory being so incredibly low, the market will probably be able to easily absorb those. So if you're waiting for the big foreclosure shoe to drop for you to run out and get some smoking deal on a house, probably not going to happen. When we talk about affordability, though, realize housing affordability and affordable housing are two different things. When we're talking about housing affordability, we're basically talking about how much money people have to take out of their monthly budget to pay for housing, right? Keep in mind in this index, the higher the number, the more affordable things are. I've done other videos about this. It seems counterintuitive. How could things be more affordable if prices are going up? Well, they actually are, and it's a function of the mortgage rate. Keep in mind that historically about 20%, 21% of your monthly income was going to a mortgage. Right now, it's only about 15%. So we'll continue to see that affordability rate continuing to rise as long as mortgage rates are held low. But remember, they're going to be ticking up. So that will start to erode. Okay. But when you consider just the equity benefit, overall price appreciation, owning made more financial sense than renting in 48 out of the top 50 markets. The only exceptions being, of course, San Francisco and San Jose. So no real big surprise there. Anyway, looking at the San Diego housing market, realize these are January 2021 numbers. Keep in mind, these are median numbers, so the true middle. They are year over year numbers, and they're for the entire county, all different types of housing. So sales price was up 9.3%. Our active market time was down 32%. That means things are selling quicker. Our sold price per square foot was up 15%. Our months worth of inventory was down 55% year over year. We're still stuck at the 0.9 months worth of inventory. Remember, we need 6 months of inventory for a healthy, balanced market. Okay. Those are all the lagging indicators. Above the line, below the line are what we call our leading indicators. This is basically where the market is going. Our active listings are down 50%. Our new listings are down 17%. So again, we're just not having enough homes coming on the market. When we look at the pending and sold listings, though, those things are up, which tells us that the homes that are coming to market are selling incredibly quickly. So still very robust. So in other words, if you're considering selling your home or right sizing your home, now is still an incredibly good time to do so. Again, with rates as low as they're at, if you're considering buying, you absolutely want to try and capitalize on these rates. So if you have any questions about these numbers, any questions about anything I've talked about in this video, if you're wondering what your home is worth or what's happening in your specific neighborhood, I'm always more than happy to have that conversation. Just reach out. Thanks so much for tuning in. And remember, who you choose to negotiate for you absolutely matters.